Welcome to Cambridge House Live. I'm Bridgitte Anderson, and I'm joined by Peter Schiff, the CEO of Euro Pacific Capital, author of many books. Welcome, Peter. Nice to see you.
Nice to see you again.
Let's start off talking about gold. Everybody wants to know what's happening with gold. You're taking a longer-term view, so when is it going to go up?
Well, it's been going up. I mean, we had a down year in 2013. In fact, it's one of the biggest down years gold's had. But you have to remember that that followed, I think, 12 consecutive up years. I think it's interesting, too, because you've got a lot of people during those 12 years that were telling people not to buy gold, it's not going to go up, and now they're there saying, I told you so. You know, they haven't really, they forget about the other 12 years and the fact that even though we were down, gold's still gone up a lot during that time period. And I think from where we are today, I think the bull market has a long way to go. I think that the fundamental factors that the gold doubters have been ignoring all along, I think those factors are even stronger than ever. I think what happened in 2013 is some of the people who had been very skeptical about gold, they got out. They came in maybe 2010, 2011. They finally got into the market, and they all decided at one time that they didn't want to be there. And I think it's all based on the false expectations of a U.S. economic recovery, which I think is an illusion. I don't think we have a legitimate recovery.
You don't think that we're seeing a recovery right now?
No, I think we're seeing a rising stock market. We've seen a rising real estate market, but that's not because of a good economy. It's because of bad monetary policy. It's the same bad monetary policy that resulted in the 2008 financial crisis. I think we're going to have a bigger economic crisis coming. And I don't think that you're going to get tighter monetary policy. People are afraid that the Fed is going to take away QE and somehow that's going to be a negative for gold. I think the Fed is going to increase the amount of quantitative easing it's doing before the end of the year.
Oh, you think it's going to be even before the end of the year?
Yeah, I think the Fed is going to do that, particularly under a Janet Yellen. I mean, Yellen is very much a believer in cheap money and inflation and Keynesian economics, and she's going to be under a lot of pressure to try to stimulate the economy, to create jobs. And she can't do that by printing money, but she doesn't know that.
And you
so
don't
that's
think
what she's
the
going to
current
do.
tapering is going to be enough then?
No, I don't even think they're going to, taper. I mean, they may do it in the short run. They may go from $85 billion a month to $75 billion a month, but that's still a very aggressive monetary policy. That's plenty of inflation, and interest rates are still at zero. But I think a lot of the economic numbers are going to deteriorate. I think a lot of the expectations for 2014 are not going to come out. I mean, you're going to have a lot of disappointed investors, forecasters, when the GDP numbers and the employment numbers are not as robust as people think, and that's going to put more pressure on the Fed and Yellen to do something about it. And the only thing that they can do, not that it's actually going to work, but it's going to be print more money, do more QE. So that's what they'll do. Do
you think timing plays into this at all? Looking at the presidential cycles and things like that, and looking at where we are now in the mandate, do you think that plays into any of the economic indicators?
Not really, although I do think that we've got a long time before the next presidential election. You're still, 3 years away. You've got the 2014 midterm elections coming up, but I don't think that's really going to have much of an impact, although I know that there's always an election around the corner. So
True.
Because of that, politicians are always focused on that election, not the long term, and so they always want a quick fix. And so we're always going to be willing to trade long-term pain for some short-term political gain. So that's what the politicians want. They want another fix, and that's why we're going to get this QE, because the economy is going to be weak going into 2014. And if you recall, for the last 3 or 4 or 5 years, everybody says we're going to have a big recovery. They're always optimistic on the second half of the year going into the year, and that optimism never pans out because what the Fed has done did not solve any of our problems. We've made our problems worse. America is more leveraged. We're in deeper debt now than we were before the 2008 financial crisis.
In fact, you're telling people to get out of the US dollar as soon as possible.
Yeah, and I've been saying that for a long time. And 2013 was a relatively good year for the dollar. I mean, at least relative to some of the commodity currencies like the Canadian dollar, the Australian dollar. It went down a little bit against the euro, against the pound, although it rallied against the yen. There was a lot of help there from the Bank of Japan. But I think the big story for the dollar is going to be weakness. And that's ultimately what is going to force the Fed to end these policies. The Fed is going to continue to inflate, continue to do QE, keep interest rates at zero until it can't do it anymore. And the only thing that's going to force the Fed to act responsibly is going to be a currency crisis, a US dollar crisis. But before we get that, they'll keep on doing what they're doing.
Well, do you think that's imminent, this currency crisis then?
Well, imminent meaning tomorrow or?
No, okay, let me put that shorter term. I mean, do you think we're going to see it in 2014 or 2015?
There's a very high probability that we will. I mean, I do think it's imminent in the long-term scheme of things.
Right.
But I don't know if it's next week, next month, next year. But as far as a long-term investor's time horizon, this is an event that you have to be worried about. You have to be prepared for it. I mean, it could have happened last year, but it didn't. So we made it through 2013, but that doesn't mean we're going to make it through 2014.
So you talk about investors preparing, and that means getting out of the US dollar, and where to then? I mean, so to gold, obviously. I want to talk a little bit more about gold, that there's been a lot of focus on Asia buying up a lot of the world's gold. What impact do you think that's having?
Well, I mean, it's going to have a bigger impact over time because right now, a lot of the speculators are satisfying that demand because you have a lot of the investor money that got in earlier, they've been selling out. And so that's been supplying the gold for the long-term buyers, Asian buyers. But the speculators are going to run out of gold if they haven't already run out. But the real physical demand around the world, particularly in the emerging markets, is going to continue to grow because what are they going to do with their surpluses? Where are they going to put their savings? They can't put it in US dollars because we're going to inflate it away. So they have to invest their surpluses somewhere. They can look at other fiat currencies, but do they want euros? Do they want Japanese yen? There's really no alternative to gold. And I think more and more people are going to return to gold as a store of value, as money, and reject these government fiat currencies because all these major governments are determined to continue to inflate because they you've got all this debt and nobody wants to allow default, even though that would be healthy, it would be better economically.
You think that would be the way to go?
Yeah, but politically nobody wants it. So, but if you have debt that you can't repay and you don't default, then the only way out is to inflate. And so that's what's happening. And so massive amounts of wealth are going to be transferred from creditors to debtors. And as more and more creditors figure this out, and they don't want to be slaughtered, they need to do something about it. And the way you protect yourself from that kind of inflation is to own real money, to own gold, and not own the currencies that are being inflated.
Do you feel like you missed out a little bit last year when you watched the price of gold go down, though, and you watched some of the markets go up? Yeah,
well, we are invested in the market, so we caught some of the upside, although not as much, because it seems like in 2013, the more foolish you were, the more money you made, because it's like the stocks that have the least amount of value are the ones that went up the most. So you had to be willing to be an idiot to make a lot of money, and sometimes I have a hard time doing that, but I do think that, if I had sold some of my gold stocks going into 2013, I could have bought them all back, for a lot less money.
Right.
And, hindsight is 2020. I didn't do that. But ultimately, I think the people who are going to regret what they did with their gold stocks are going to be the people who sold. Because I think most people who sold are not going to buy back. At least, not at lower prices. They might chase the market when it's higher. But I like what I own. At least I wasn't levered up, so I didn't have any margin calls. I wasn't forced to sell any stocks at, fire sale prices. I'm sure there were some people who, really bet big, and unfortunately, they were in a position where they might have had to sell some stocks that they would have preferred to have held on to. But, I'm not going to follow the crowd just because the crowd is doing something foolish and they're expecting a greater fool, to take them out of their position. I think if you stick to the fundamentals, you're going to make money in the long run. And I looked at 2013 more as an opportunity because I own personally, I have a much bigger position in the mining sector going into 2014 than I had going into 2013. So if we go back and make new highs, I mean, it's going to be a lot better for me this time around. Now the question is, will I sell? I've ridden a lot of these stocks up and down twice now. And so we'll see. I mean, I think I'm determined to hold on.
So what are you seeing then on the mining sector?
Well, there's a lot of opportunity there.
Yeah.
There's some consolidation, but also, because of all the negativity, I mean, the consensus is so overwhelming that gold and silver are dead, right? They're just going to go down. That the mining sector is having a hard time. They're not investing in capex or research and development. They're laying people off. Look what's happening with the employment numbers in Canada, in Australia. That's one of the reasons that these currencies are going down, is people are anticipating that the layoffs continue, and they think that the central banks are going to come with monetary stimulus. But I think that's all wrong. I think that the layoffs aren't going to continue, because as the price of gold starts to rise, the layoffs are going to stop, and eventually they're going to start hiring some of these people back when the market moves up enough that the confidence comes back. Because I think that this was a huge shakeout in 2013. I think just about everybody's got it wrong. I mean, Goldman Sachs is still out there saying gold's going down to 1,000 because the Fed is going to continue to taper as the U.S. economy improves. Well, Goldman's got it completely wrong. The U.S. economy isn't going to improve. It's going to relapse into recession. The only thing standing between the U.S. and recession is quantitative easing, 0% interest rates. And, I've been saying for years, when you have an economy that lives by QE, it dies by QE. You cannot take it away. It's not like, you can just achieve some kind of escape velocity and then the Fed can dial it back. Our economy is completely dependent on that QE. And in fact, just like any drug, we need more and more QE to stay high. So the Fed is going to figure this out under Janet Yellen, who, by the way, is the first Democratic Fed chairman. Greenspan was appointed by Ronald Reagan in '87, and then Bernanke by Bush. And they were pretty bad. Well, imagine how much worse this Democrat appointed by Barack Obama is going to be.
And you think it's going to be worse, for sure?
Absolutely. Look, if you go back and you look at when Alan Greenspan left in 2006, after being Fed chairman for so long, everybody was praising him. He was the maestro, and everybody was excited about Ben Bernanke. He's his protege. He's going to follow these great policies. We were 2 years from the 2008 financial crisis. Nobody saw it. Alan Greenspan's bubble blew up on Ben Bernanke's watch. Then what did Ben Bernanke do? He repeated all the mistakes. He blew an even bigger bubble with even more reckless monetary policy. Now he's getting out of Dodge just in time. Janet Yellen's coming in. Everybody thinks Bernanke was a hero, and they're very excited about Yellen because she's going to follow in his footsteps. Yeah, she's going to inherit a bigger bubble. It's going to burst on her watch.
And do you think
she's
investors are prepared for that?
No, they're not prepared for it at all, just like they weren't prepared for it in 2006. Just about everybody was blindsided by the financial crisis, even though it should have been obvious. This crisis that's coming should be even more obvious, yet even more people are going to be blindsided. Because if you remember, even in 2006, gold was still rallying back then. There was still a healthy amount of skepticism about what the central bank was doing. Now most of the skeptics have been silenced. They've all signed on. Everybody believes that the central bankers have got this thing, solved. And so there are even fewer people worrying about a crisis now than there were in 2006, even though it's a bigger crisis.
Well, investors definitely have got some interesting times ahead, don't you think?
Well, I guess that's a Chinese proverb, right?
Peter, thanks very much for your time. I appreciate it.
Thanks for inviting me.